What's up, Piers, and welcome back to the World Crypto Network. Only 4 hours since the last show. Took a quick nap in the hammock. That's all you need. Hammock gives you enough energy. And we're back here on the show, Open Source Everything. We're talking to Samson Mao. What's up?
Hey guys, how's it going?
Well, Samson, so we're probably a lot of the audience already knows you, but could you just give a brief introduction about what you do at Blockstream?
Sure, I'm the Chief Strategy Officer at Blockstream, and I'm taking care of product, business, and marketing.
Perfect. Yeah, a lot of organization things to do. So good that we have people dedicated to it, and of course active in the hat wars, because that's important. Memeing and trolling on Twitter.
Less time for that these days.
Oh, that's a shame. Well, so sidechains are trying to solve a problem. What is that problem on Bitcoin on the main chain?
So sidechains are a way for traders, market makers, and the like that could use it to trade faster. It's essentially making it easier for people to move funds, move large amounts of Bitcoin around the network in fast and reliable times.
And so what is the problem on chain? Why can this not really be done on the Bitcoin base layer?
It can be done on the Bitcoin base layer, but then you're subject to variance in miners with times and block times. So you can't always guarantee that you get a block every 10 minutes. People think that you do, but it's actually roughly every 10 minutes. You can get 3 blocks in 10 minutes, or you can get 1 block every hour, or at worst, I think I've seen it go for maybe 2 hours or 3 without a block. So it's not guaranteed that you'll get your transactions confirmed. And if you're moving large amounts of Bitcoin, you actually need to have those confirmations. If not 1 confirmation, then 6 or more, because exchanges need to make sure that they actually receive the Bitcoin. So with Liquid, you actually are guaranteed 1 block every minute. It's based on a timer, not because it's mined. It's federated signing, so we can guarantee every single minute there is 1 block. That means in 2 minutes or 2.5 minutes, you're guaranteed full settlement.
Okay, and so what are some other restrictions, especially with the new stuff that is being added to Liquid, and why can technologies like confidential transactions not be as easily implemented on the base layer? What is the upgrade mechanism here?
So it's harder to upgrade Bitcoin, and that's largely because of Bitcoin's design. It's not meant to be changed easily. If you could change it easily, then people could change the coin limit to 42 million and add inflation, or do all sorts of things that could basically ruin Bitcoin. But with the sidechain, you can peg in Bitcoin into this new blockchain, and you can have a totally different rule set. So for Liquid, we have faster block times. We can have things like confidential transactions, confidential assets, and it just opens up a new playing ground where you can do an experiment with a lot of different things.
Right, on the Bitcoin base layer, everyone hopefully is running a Bitcoin full node, and thus everyone is verifying consensus. And if you want to adapt this consensus and quote unquote upgrade it, well, you cannot force the new software on everyone's hardware, especially if it is consensus critical and requires a lot of testing and trust before people usually deploy it. So what other technical features do you think could be added in a sidechain that would be restricted by the Bitcoin consensus?
Well, it's not just things are restricted. It takes more time to upgrade Bitcoin. So for Liquid, as long as the members of the Federation agree, we can make an upgrade every 6 months or a year or on some schedule. So we can have new things roll out, like signature aggregation, store signatures. That could be deployed in the near term. I think Adam and I want to have simplicity deployed into elements and potentially on the Liquid sidechain, so we could do more advanced smart contracting on top of the existing Bitcoin smart contracting.
So is it really the case that you can do pretty much anything you want on the second layer? It doesn't even have to be a blockchain. It could be a DAG-based system, or if that ever works.
Well, I think it's still a blockchain. You would still need to peg in coins in order for it to be a sidechain. Otherwise, it would just be an exchange where you send it to somebody's wallet and they would give you a representation of your Bitcoin in a database on their website, right? So I think for anything to make sense, you would still want it to be a blockchain.
Yeah, and everything is possible with a blockchain, of course.
That's right.
So, and another important question, especially on the economic side, is let's step back a bit. What is our base monetary unit? What is that money, like the atoms in a silver coin, right? Where is the end? What is the base layer monetary unit in the Bitcoin ecosystem?
Well, there's a bit of debate about that, isn't it? There are people saying it should be Satoshis, and there are other people saying it should be bits.
Well, but that's the nomination of the base asset. What I'm asking more that is it the true base layer to hand over your private key, to have it on an open dime and pass the private key, to not use asymmetric cryptography as it is being used? Like, is that the base layer? Or is it a proper signing of a Bitcoin transaction that contains a UTXO and broadcasting that over the network? But is then the transaction itself the base unit? Is it the amount of UTXOs?
That's an interesting question. I haven't really thought about that. But I think the net effect would be the same regardless of how you pass it around. It's just easier to sign the transaction than to pass around an open dime.
Yeah, and I mean that is how Bitcoin is supposed to be used, right? It's not hand over the private key. Those are credit cards, and they were perfect. Bitcoin leverages asymmetric cryptography, and this entire nonsense about mining and nodes and consensus is a big part for not handing over your private keys, but retaining them and using them in a signing process.
Right. So you're saying you don't like open dimes?
Oh, I love them, and especially the cold card right back here. But OpenDime is amazing. However, I do think it's a hack around Bitcoin. It's not really how Bitcoin was supposed to work. However, it might be the only or one of the few physical representations of a scarce Bitcoin. Because if you have a copy of the private key, it's still yours.
Right. But I think with open dimes, you cannot extract their private key. So if you fund an open dime, then essentially it is a bearer asset.
Exactly, right? And that will be the problem with having a poker chip that has the Bitcoin QR code on it, the private key QR code. And if you hand that over, or Alice hands it over to Bob, then Alice could still have a copy of that private key because it was generated in the open. And with OpenDime, it hacks around that by keeping the private key hidden off the stick itself and removed on the stick. So that is, it's quite a fascinating model. But now when we have Bitcoin as the UTXO on the base layer, then what is, for example, a Lightning Network payment channel where you put these Bitcoin on a 2 out of 2 multi-signature wallet on chain, right? And that is accumulated with proof of work, or buried in accumulated proof of work. And then you only, with transactions inside the Lightning channel, you use asymmetric cryptography to shift the state of the final balance of this multi-sig. So what can we call this new type? Is this a new money? Is this a new token being issued?
Well, I don't think it's a new token. It's still a layer 2 solution. So anything that is transacted not on chain, I would think, could qualify as layer 2. I don't know about open dimes being layer 2, but I think Rodolfo would love it if we called it a layer 2 scaling solution. But I don't really think it is. I think things like sidechains and the Lightning Network would qualify as a second layer, where you're not moving UTXOs necessarily.
Yes, interesting. And then the question is, with sidechains, you still have a multi-signature on the base layer, right? A opening peg-in transaction into the federation multi-sig.
Yeah.
But then you do not shift the state of this inherent UTXO, right? But you create a new currency, a new token that is being issued with the creation of the multi-sig wallet. So could you please go a bit more into how this peg-in transaction works and how this new token is being issued?
So the way we like to frame it is not that there's a new token being issued. Based on the consensus rules of Liquid, there are also 21 million LBTC that can be unlocked. So it's more that you're locking Bitcoin on the main chain and unlocking them on the sidechain. So you cannot actually access a Liquid Bitcoin unless you have a Bitcoin. It's a bit of a difference in, I guess, how you frame it. If you're saying, because there's nothing really being created, they already would exist and you're just accessing them. So it's not like there is a new thing being issued.
So when was this point of setting the 21 million cap? And is it correlated to the amount of Bitcoin on chain increasing with 12.5 Bitcoin every block, or is it already fixed at 21 million?
I think it's already fixed at 21 million based on the, well, it's based on the consensus rules in Liquid, which is a fork of Elements, which is a fork of Bitcoin.
Okay, and however, there's still a new digital representation called the Liquid Bitcoin. How is that different from the base layer on-chain Bitcoin?
It's the same thing. Like if you're looking at it from a code perspective, it would be very similar, except for any transactions of this asset would be confidential.
Right, but in the aspect that there are confidential transactions and federation signing on the sidechain, doesn't that make the token inherently different, a different good? It has different attributes, different trade-offs. So it is different from Bitcoin in some senses.
Yes, it is different because it exists on another chain, but it's not like it's a new token. It cannot exist independently from Bitcoin. So it only comes into existence if you lock up a Bitcoin. So I think it's really like how you decide to explain how this thing exists. It doesn't really, it's not a new thing that is generated. It's unlocked. So unless you have Bitcoin, you cannot have LBTC.
But wouldn't that be the similar case with something like colored coins? That they can only exist on top of Bitcoin with some existing Bitcoin?
Well, for color coins, they don't really, let me think. So color coins are essentially tagging a bit of a Bitcoin in a transaction and saying this is related to something else, right? So you can basically say you have a max coin, or actually there is max coin, isn't there? You can have, okay, let's say World Crypto Network coin, but that would only be transacted whenever there's a Bitcoin transaction. That's my understanding of how color coins work. So you can say there's a specific ratio, and every time that transaction happens on the Bitcoin network, then you're transacting the colored coin.
Yes, so there's the difference in the way of sending the colored coins compared to sending a liquid Bitcoin. But what if in this new consensus of the sidechain, it would be a complete fork of Liquid, but it would just add twice as many liquid Bitcoin? Could you still classify that as the same asset as Bitcoin, or where is this line drawn, where a break in consensus is no longer considered than to be the same asset essentially?
Okay, so you're saying you could have a sidechain where one Bitcoin could unlock 2 liquid Bitcoin, right?
Is that possible? That's a question, yeah.
Well, you could do anything you want. You could do a 1 to 10 ratio too if you wanted to, But for Liquid, it's only 1-to-1.
Yes, but so you're saying that you're breaking the base layer consensus with Liquid in some aspects, right? Adding cool stuff like confidential transactions. And when you only change this aspect, it stays the same as the ultimate asset because it is pegged 1-to-1. But if you would increase the peg and increase the fractional reserve, so to say, no, not really. I'll take that back.
Well, okay, so it would depend on what you're trying to accomplish on the sidechain. So you could allow pegging into another chain, let's call it World Crypto Chain, and you could have a different ratio. So if you locked up 1 Bitcoin, you can get 10 World Crypto coins. But then I think it doesn't matter because the exchange rate back would still be 10-to-1, right? So you could do that, but I'm not sure why you would do that. It could just be because you wanted more coins, but the net effect is going in and out. It would still be the same.
Yes, and can after the fact, can this, or no, can phrase differently, how is this peg secured cryptographically? So how do we really make sure that every liquid Bitcoin has to be issued only after 1 Bitcoin has been locked up?
Right. So the Bitcoin, the peg is secured by the members of the federation. So essentially, you can think of it as a very large multi-sig. So everybody in the federation is signing off on a block, and they're the ones that actually are maintaining that peg. So as long as 2/3 of them sign off, then you generate a block.
Okay, and so in the federation, there are 2 different groups, right? There are the block signers who take care of the 1 minute block creation, and then there are the watchmen who, as far as I understand, take care of the pegging in and out.
And it's the same right now. So the function, there's 2 functions, but they're in the same box.
Okay, yeah, that makes a lot of sense. So, and what is the threshold? Up to what point do we have to trust that they cannot collude and cannot take away the funds?
It would be 2/3.
And so when they would have more than 2/3 on their side, if more than 2/3 collude, how would this stealing process work?
Well, if there's more than 2/3, they would have to change the whitelist, because right now you can only peg out to whitelisted addresses. But then there's a period where you'd have to notify the network where the peg out whitelist has been changed essentially. And there's a delay for that. So it's not instantaneous. So then that can be monitored, and then everyone on the network can see if that has been changed outside of any regularly scheduled change.
Okay, and who owns this this whitelisted address, and where do these funds go to in the pegging out transaction?
Well, when the members join, they generate the address, or they provide the address they want to peg out to. So they provide the address. And I'm not exactly sure where it's maintained, but essentially it's part of the system.
So, and when you say that those that join this multi-sig, who exactly is that? So who's able to be part and put funds into this multi-sig, and what are the responsibilities of that entity afterwards?
Sorry, who can put funds in?
Yeah, exactly. Is that limited to the federation members?
Yeah, so only the federation members can peg in and peg out transactions. So if you're a user of Liquid, if you're not a member of Federation, if you're just a user of, say, of Bitfinex, then you would have to go to Bitfinex to peg in. And if you have LBTC, you'd have to go to them or one of the other members to peg out. So it would peg out to their authorized addresses.
Okay, yes, that's interesting. And how is this signing process, especially now talking about the block signing, how is this being taken care of, and how are the round robin styles, and just could you go a bit more into that?
I think that's beyond my technical ability to describe.
Okay, and I've heard now a bit, but I couldn't find more detail on it. That some secure hardware is required, some sort of black box. What is that all about?
So there is a functionary box that handles the block signing.
And who has built this box, or who is issuing it?
So that's built by Blockstream.
And so what exactly does that do, and why do we need this this Blockstream created box? Why not just a normal Raspberry Pi?
Well, there's a lot of security measures that have to be put into place to make sure that the network is secure. So there's a hardware module where the private keys are kept separate. So it's essentially a 1U server with a bunch of different components in it. So you mentioned there's a block signer, there's a watchtower, and then there is also the private keys. So these are all secured inside this 1U server, and they're distributed around the world. So that it would not be secure to use a Raspberry Pi to secure the network, essentially.
And because these federations are non-dynamic, right? They are known entities and they're known in advance. Will that attract more attackers and hackers, essentially?
It would be difficult to attack because they're geographically distributed, and we don't actually know where they are once they're distributed to the members of the federation. So we just know roughly that they're in a country, and they could be in their data center, another data center, or any location. And if you wanted to attack the network, you'd have to compromise 2/3 at the same time.
So how much of this hardware is open source and available for inspection by everyone?
How much of the hardware is open source?
And the software running on top, so the entire black box, so to say.
I think it's going to be licensed to the members of the federation. So a lot of the software on the box is not open source.
Okay, and how do we make sure that these really important boxes and servers are working correctly, and that we can verify that there is no shady stuff in there?
Well, what do you mean by shady stuff?
Well, for example, some algorithm that censors transactions happening.
So I think most of the code would be, so the Liquid daemon is going to be running on the boxes, and that's mostly open sourced. And there's some components that are not open source. But the hardware and the design of the hardware is not open sourced. But the boxes essentially function on their own, so there is no real way to interfere with the system. So you can either turn it on or turn it off. You can't really modify and change transactions or not process certain transactions.
Okay, yeah, and so the usability of the server is limited. Is it kind of like a specialized hardware similar to a hardware wallet that only does one thing, and therefore is quite limited in the attack vector, or is it more of a general purpose computational server?
I would say it's more like a limited hardware wallet if you wanted to compare.
Okay, cool. So because Liquid is a sidechain, right? This Elements is a sidechain. It can be used in cross-chain atomic swaps. And so are there going to be these exchanges between the Liquid Bitcoin to either other altcoins, but especially Bitcoin on the blockchain or on the base layer blockchain itself?
So your question is, will there be atomic swaps between LBTC and BTC?
Yes.
It's right now, it's not, there is no swapping because right now the blockchain is live, but we're still working on integrations. So right now, nobody actually has LBTC to swap with you. But eventually, because the transactions cannot be censored and they're all confidential, we can't really know if people are swapping or not swapping.
Okay, so but theoretically, there are possibilities of exchanging these Liquid Bitcoin for the base Bitcoin?
Correct.
And will that be handled with the Federation as well? So will it be on their exchanges?
Well, it depends. I mean, if you're going through an exchange, they would probably just let you withdraw LBTC. So I don't think we have any plans to build any systems like that off the bat, but it's definitely possible to construct the transaction on your own and just do a swap with somebody on the main chain.
Okay.
But later on, we'll have to see. I think some people are interested to play around more with that. So they might build it into a standalone client or an app or something like that to make it easier for people to swap. But right now, I don't think atomic swaps are that popular. It's hard to really match the trade because technically you could do atomic swaps between Bitcoin and Litecoin, but that's not really a big thing right now because it's much easier just to buy on exchange or trade on exchange.
Yes, okay. And I'm asking because if there are possibilities of exchanging your liquid Bitcoin to base Bitcoin, then it's so difficult with all these names now. Then there is a market price for it, right? There is an exchange value. And the question that I'm asking is, how can we make sure that this exchange value on the free market between two individual peers, is that influenced by the peg and the multi-sig peg in and peg out? Because these individuals, Alice and Bob, are not necessarily part of the Federation, and thus they don't have the ability of liquidating or destroying their liquid Bitcoin and getting their base Bitcoin back out of the multi-sig. So this arbitrage opportunity might not be given to Alice and Bob directly. Basically, I'm asking, does the peg hold?
Well, if you're pegging in and out of the system, then the peg will hold. If you're doing atomic swaps, like it's really up to the market, right? If you wanted to do a swap, you could pay more or less. It just depends on what the two parties decide.
Exactly, right. It is a free market barter. And so do you think that there might be different purchasing powers, different prices for both Bitcoin on-chain and Bitcoin Lightning and Bitcoin on sidechains?
I mean, anything can happen, right? Markets are markets and people can decide what they want to do. Someone might just want to do a swap that's not one-to-one, right? But who's to say they can or cannot do that?
Yeah. And how these pegs work and how these function is by arbitrage, right? If people pay too much on a swap in direct peer-to-peer exchange for their liquid Bitcoin, so they pay 1.1 Bitcoin to get their hands on one liquid Bitcoin, maybe because they like confidential transactions very much. We all do. So that might be a reason why they overpay, quote unquote. But how fast can the Federation use up that margin, that arbitrage opportunity, or are they going to do that at all?
Well, I think into the territory of eventually maybe there are LBTC order books, right? But if people are just using it as a way to transact and send Bitcoins back and forth to the exchanges, then I don't really know if that market would develop. And it's highly unlikely that anyone would want to pay more than one-to-one in any swap. It just doesn't make sense because you could just go and peg out via your exchange or swap with the exchange.
Yes. But especially if there would be a higher market price, then the Federation could sell their liquid Bitcoin for 1.1 Bitcoin, and then they could buy or create additional liquid Bitcoin by putting these 1.1 Bitcoin back into their multi-sig, receiving 1.1 liquid. So they have realized this 10% arbitrage.
If there is if that happens, it'll be pretty surprising. It just doesn't seem likely. If it happens, it would only last for a short amount of time because it just does not make sense that market would develop and sustain itself. I mean, I think people would be more likely to use Liquid to capitalize on different prices on different exchanges by moving capital back and forth to arb it out.
So the arbitrage opportunity is more with using Liquid and the faster blocks and the faster confirmation, rather than with Liquid back to Liquid. So is Liquid then the perfect Bitcoin stablecoin?
In theory, I guess it's like a parallel Bitcoin that you can only access when you lock up your Bitcoin.
Yeah. And could we then say that Liquid is a altcoin?
I don't think so, because altcoin would have to be able to exist on its own, right? Liquid cannot exist without Bitcoin.
But the Elements project can exist, or the Elements sidechain can exist without being a sidechain and being a blockchain in and of its own. So is that just inherently the attribute of Liquid or Elements, or can any blockchain also be deployed as a sidechain?
Well, I think we're getting into some terminology here. So the question is, what do you define to be a sidechain? And there's been some debate on that, right? I think the way that we've defined it is it's another blockchain that is related to, it's a blockchain that's related to another blockchain. So in this case, it's pegged to Bitcoin. So it is, by definition, a sidechain. It's pulling data and accessing another blockchain. But you could, I think some people have said, what was the other coin? Namecoin is a sidechain too, because it's merge mined. But I mean, you could not merge mine it if you really wanted to. So I think it's really getting into definitions here, what sidechain means.
Okay, and when you bring up the topic of merge mining, where's the difference from having a merge mine sidechain and having a strong federation model sidechain?
Well, for merge mining, it's because anybody can be a miner. It's much easier to be attacked if you're a merge mine chain. So you just need a minority of hash rate to attack the peg, essentially. And that's why I don't think anybody is using a purely merge mined model for securing their sidechain right now. So I think Rootstock is merge mined, but they also have a federated federation on top of that. So it's like they take the merge mining as additional security on top of the federation. But ultimately, I think the federation would determine, would maintain the peg, not the miners. That's my understanding, at least.
And so why should we trust a known and limited amount of actors, for example, these exchangers, more than a dynamic set of miners? Because in Bitcoin, we can do with this dynamic set, right, on the base layer. We don't need to trust these miners. So would this be the same case for the sidechain?
So in the case of Liquid, it's built on top of the strong federations concept, which means all the members are incentivized to secure the network because their end users may be using the network. It's not just that they have no skin in the game. They have skin in the game because they're offering this as a service, essentially. So if they attack the network, they're basically attacking their own users, and that would not be really good for any exchange or member of federation currently. But if you're a miner, well, first of all, with mining, it goes into multiple levels. So you could be a miner, but you might join a pool. And there are not that many pools for Bitcoin, maybe 15 or 20 or so. It fluctuates. But the pool operators can decide to attack if they choose to, without needing permission from the miners themselves. So that's why I think it's easier and more risky to rely purely on merge mining to secure a sidechain.
Okay, and although there might be the incentive that the individual federation members don't attack the network so that they protect their own users, it might as well be the case that they are trying to attack the network so to hurt other exchanges, their competition, so to say.
Right, but then you need 2/3 to collude and attack together. And that's almost impossible because then, in that case, you'd be also worried about a 51% attack on Bitcoin, right? Because you could have that happen on the main chain too, that level of collusion between all the mining pools. But that's really just shooting yourself in the foot or worse.
Mm-hmm. And
the difference, I think, is that the miners are incentivized to secure Bitcoin because they want to get paid. But they may not be using a sidechain. They might not be using Rootstock. They might not be using Liquid. So there is no incentive for them to secure that. They could just attack it for fun.
Mm-hmm. And so what are other incentive models for the federation itself? Are there fees involved?
You mean service fees? Support fees?
Yes, exactly. And fees that incentivize or payments that incentivize good action and punish bad?
Well, the good action is that people would use Liquid and move funds around more readily, and they would increase their trading volumes and make money, like indirectly. In terms of fees, like Blockstream we have a support fee. It's $2,500 a month, and that's basically the Red Hat enterprise Linux type model where we provide support.
Okay, and are there individual transaction fees for the end user?
Yeah, so transactions in Liquid are also paid for by the end users. Like if you and I made a Liquid transaction, then we would have to pay a little bit of LBTC for fees.
And how much is that compared to on-chain transactions or base layer transactions?
The calculation is the same. So I think the minimum is 1 Satoshi per byte. But Liquid transactions are bigger. But I think I forgot if it's 25% or 1/10. But it should be we think it should be cheaper in Liquid than on the main chain. I forgot the pricing of the transactions. I have to check.
And so are the same metrics relevant as for Bitcoin base layers, so the size of the blocks and the block time and the size of the transaction? Or are there any other calculations involved with with calculating the fee and estimating?
It should be the same fee estimator as Bitcoin main chain right now. I have to check on that. I'm not sure exactly. But when we were designing it, I think we did plan for lower fees, but then the size of the transactions were bigger. I can't remember exactly. I have to check.
Well, yeah, talking about the size of the transaction, that is mostly because of the confidential transaction aspect and the proof of the Patterson commitment. And then now Monero has just recently activated in one of their hard forks bulletproofs, and that has reduced the size of the transaction and the verification time drastically. Is our bulletproofs coming to Elements as well and Liquid?
Eventually, that's the plan.
Okay, cool. Because that will hopefully make Bitcoin or Liquid even more usable and fees even smaller. Because thinking that there are shorter block times, and what is the block size?
It should be the same. I think it's 4 mega weight.
Yep. Okay.
But you have every minute you have a block, so it'll be a different fee market. It'll probably be cheaper because the blocks are coming faster, and I don't think that we will have the same demand as the main chain, because the main chain can be used for a lot of different things, whereas this is just for inter-exchange settlement and moving issued assets around.
And the fees that are paid by, or transaction fees to be specific, that are paid by the user, who do they go to of the entire federation?
It goes to a wallet that pays for the peg out. So right now, we really don't know how it's going to take shape on Liquid, but it could be that wallet will run a deficit based on how many people are pegging out and the fees that we pay to peg out. So it could be that it will need to be topped up from time to time, but we expect that the fees collected will essentially be consumed by the peg out process. So essentially Liquid is paying for the peg out. It's paying fees on the main chain to peg out.
Okay. Interesting. And are these fees paying for the on-chain or Bitcoin base layer on-chain transaction fees?
Yes.
Okay, and especially with such a volatile fee market and maybe another spam attack as we saw in November, December, which might hike up the fees, might greatly reduce or increase the costs for pegging out, and thus having a kind of like a reserve fund is quite interesting.
Mm-hmm. We'll see. I mean, right now on the main chain, fees are pretty low. I think that has to do with several things. But we'll to see with the next bull run what happens.
Oh yeah, crazy stuff is always happening in Bitcoin. Interesting. So are there any financial incentives for the Federation miners? Because I thought that the fee was going to them, but apparently not.
Well, like I said, the financial incentive is really just to increase the amount of trading and to derive indirect benefits. But their motivation for running the blocks is to secure the network. Just like, they're a miner essentially. They are providing this network security. So that should be alone enough to incentivize running a box.
But are these external incentives enough? Are these secondary effects of your users have a better product, thus they use you more? Is that strong enough to rely upon the working together of all these exchanges with a lacking of internal incentives baked into the system itself?
Well, we'll have to see. Right now, it's hard to say, but if Liquid is successful and there's a lot of trading volume and there's a lot of transactions being routed through, I think everybody should be able to generate more revenue. With issued assets, it should lower their overhead as well. They don't have to run separate. Like if everyone is using issued assets to issue things, then they don't need to run different clients, and they don't have to deal with security risks. They don't need to deal with Ethereum scaling issues. It should be overall a better play and a better decision to run Liquid.
Okay. I'm curious how these incentives will work out, because consensus is difficult and unexpected. So really curious how these sidechain consensus mechanisms will evolve. Quite interesting.
Right.
So I talked to Adam from Wasabi Wallet, Nopara, on Monday, I think, and asked him about confidential transactions. And he's basically, that solves it all from a privacy standpoint, pretty much. So there are, of course, many advantages of having confidential transactions. And could you please go a bit more into what these are, and especially for exchanges?
Well, I think having confidential transactions will be a big boost, because they won't have people monitoring their cold wallets and saying there's a lot of Bitcoin incoming, you better watch out, or there could be speculation as well. I think recently Binance was posting and that said, we're going to move some money in our cold wallets. It doesn't mean what you may think it means. We're just organizing and cleaning up or doing whatever, right? But you won't have to deal with those kind of overheads, that kind of overhead and frustration where people are speculating what's happening. For traders, it is definitely beneficial, because then people can't watch the blockchain and front run. You could be monitoring some guy's large wallet and see funds are being moved to BitMEX or whatever, and you might think, okay, I'm going to go and trade against them. And that can be bypassed by confidential transactions.
Oh, cool. And do confidential transactions mess with the order book process of the individual exchanges?
Well, no. Once it hits the exchange, then the exchange would credit you, and you'd be trading on their trading engine, and your funds would be credited in their database. But potentially later on, you could have a trustless exchange, and OTCs could just trade between one another with LBTC, and it'd be confidential.
No, exactly. And although there are, of course, many advantages of having these amount of the transactions opaque and intransparent, it is nice to be able to aggregate all the unspent transactions output on the Bitcoin blockchain and realize that they truly are, what, 17.5 million Bitcoin of them, and that they're still in part of the 21 million consensus. That is a problem in Monero, that we cannot do that, right? With confidential transactions, it's just not possible. So we can, how can we make sure that there's no hidden inflation on the liquid sidechain?
I think I'm not too sure, but I think there are ways to still validate. Actually, I'm pretty sure you can validate that, but I think that's a more technical question. But we do have some things that we're building to make it easier. So we have some proof of reserve tools that we plan to offer exchanges so they can do an audit of their liquid balances and show that everything does add up.
Okay, interesting. And now let's assume hypothetically that in such a sidechain, federated sidechain, there are additional sidechain tokens being created due to some bug in the software or whatever. Can this inflation affect the Bitcoin base layer consensus?
No, it wouldn't, because that's the whole point of having a sidechain. It's a firewall. So anything that goes wrong on the sidechain will be constrained to that sidechain.
Oh, yeah, exactly. That's the cool thing with having this multi-sig as kind of the gatekeeper, is that there can only move enough liquid Bitcoin back into the Bitcoin base layer blockchain as were Bitcoin locked up in that multi-sig before, right? Maybe a couple more questions about that multi-sig specifically. Is there going to be one giant multi-sig that issues all these liquid Bitcoin, or are there going to be several smaller ones?
It's one multi-sig, and we actually are working on having dynamic federations in the future. So we would be able to dynamically add and remove parties from that multi-sig.
Okay. So, but isn't that basically a giant honeypot, having all these funds in one multi-sig without any diversification throughout other UTXOs?
Well, it's a giant honeypot where you have to compromise 2/3, and it's not easy to do. So the example I would give is, it's like Ocean's 11. You'd have to put people on different continents and coordinate and find all the boxes and reach them at the exact same time in order to compromise the network.
Yeah. And we have seen here how difficult coordination across time and spaces on the other side of the globe. That's a nightmare for time zones. So it's hard for attackers. It's not easy. So yeah, okay, interesting. And you spoke about cold wallets on the Liquid sidechain. And I do think that is one of the main advantages of Liquid, is that you are in control of your own private keys of the Liquid Bitcoin. So do the same concepts for cold storage apply on sidechains as on the base layer chain?
So can you repeat that?
So how is the cold storage handled in Liquid? Are there any major differences compared to cold storage on the Bitcoin base layer blockchain?
No, it would be the same. So if you're an exchange, you would use the same procedures you use to secure your Bitcoin as Liquid. And I think that's part of the elegance of the solution, which is that you don't need to rebuild your architecture. You can just follow your same procedures and use the same systems to manage that.
Yes. Yeah, cool. That it basically is Bitcoin, right? With some added tweaks. So
yeah. I would say it's like an augment to Bitcoin.
Yep. Oh, cool. And so talking about these augmentations and these quote unquote upgrades to Bitcoin, how are they handled on the sidechain? So how are updates being done on the consensus level of the federation?
So right now, I think we're scheduling major updates to be every 6 months, and we would just coordinate with the functionaries to deploy that.
Okay. Cool. We already talked about a lot, and maybe let's share screen here and let's go in the troll box, in the chat box, and talk a bit here. Agartha, thanks for joining us in the chat. She asked that when she or he will be able to bet with my BTC on the escrow address to challenge anyone to app game out there, like eBay, but for betting with crypto. Okay, wait, no, I don't even think that question makes any sense. Do you get that question?
I don't get it. I see another one. Bcash doesn't need liquid.
Do they?
I don't know. I don't know what they are. Which Bcash? There's going to be 3 of them in a couple weeks. That's the question.
Exactly, right? So they're having consensus troubles on the consensus breaking fork. So guess what? They break consensus. That's what they do.
Yeah. But if you're worried about security of a minority chain, you can actually just issue that and trade that issued asset in liquid. So you could just dump all your Bcash. Well, I guess if it's a fork, people want to get their payday from the other forks by selling the other forks. But let's say you're just like a less secure coin. You could just issue that coin and trade the issued asset instead of the coin on the exchange. So then the exchange knows that they don't have to worry about 51% of tax, assuming you just keep a bunch of it in cold storage.
Mm-hmm. Okay, oh, cool. And we also have Bitcoin Jake saying that he loves the Magical Crypto Friends. So yeah, shout out, absolutely, cool podcast.
Yeah, I do too.
And Jeremy asks, when liquid cash? So will we have a consensus level drama as we saw with Bitcoin and Bcash on sidechains as well? Can that happen?
Well, someone could always build their own version of liquid. The most of the code is open source, so you could take elements and create your own. You'd have to build your own hardware, but that's not impossible to do. So someone could make liquid cash if they really, really wanted to.
Mm-hmm. Yeah. That's the beauty of open source software and hardware, right? It can be copied, and that's good, right? And that's competition, and that keeps us going. Keynote Sean asks says that it would take a lot more energy to 51% attack Bitcoin on the base chain than collusion within the Liquid Federation. It seems interesting and helpful, but requires trust in the third party. So what do you say to the inherent trust that is needed for a sidechain, Federation sidechain?
Well, let's go to the first part. It takes a lot of energy to 51% attack. It depends on the type of attack. If you're thinking about an external group trying to get 51% of the hash rate, then yes. But you could just have a bunch of mining pools decide to collude and reverse a transaction or reorg so that one transaction goes in first. And that just takes collusion. It doesn't really take any energy outside of what they're already using. And the thing with mining pools is there is trust from the miners concentrated in the hands of the pool operators. So it may not necessarily be that the miners want to do anything bad, but the pools can collude just in the way that any liquid functionary could collude as well. I think a key difference is that with the liquid, you're dealing with these exchanges that have been operating for a long time, and they're real companies, real entities that operate within the law. So if they did collude, you could probably sue them.
Yeah, that is the let's say reputation market, and the reputation both you pledge your previous your historical reputation and also your future reputation, right? Because if these exchanges would collude, hopefully nobody would do business with them in the future.
Yeah.
We have Bitcoin Jake. Thanks for being active in the chat, and especially for the $2 donation. That's amazing. So he's watching here, Samson.
Yeah. Hi, Jake.
Okay, interesting. And Booger Guy has a really cool question about issued asset concept and how that works, especially with the cool attribute of it being confidential. so that you neither know the amount nor the currency that or asset you're transacting. So how does that work?
So an issued asset is essentially is a native asset. So you can think of Bitcoin as one kind of a native asset on the blockchain. So an issued asset is functioning at the same level as Bitcoin, compared to, say, on Ethereum, where a token is generated in a smart contract, basically, using JavaScript. So any issued asset is just another data type similar to Bitcoin in the Liquid blockchain. And it does have the benefit of being confidential as well. So when you're transacting these tokens, they would be shielded. You can't see the type or the amount. So everything, if you're monitoring a Liquid network, all you do is see a bunch of transactions happening. You don't know if it's a Liquid transaction or issued asset 1, 2, or 3, and for how much.
Interesting. So does that basically allow for now anonymous ICOs of anonymous quantities? Do we really want that?
It depends. I mean, with a lot of token issuance, you're still relying on a company to issue, right? The company that issues it is the key point. That's why it doesn't really matter that much. I think I need to double check, but I think when you issue, you can either choose to be confidential or not confidential. So you can leave the issuance open. So you could see that I issued 1 billion max tokens, and after that, the transactions would be confidential, but the initial issuance would not be. But I think it's a setting that you can make. I need to check. But yeah, I mean, I think it's nice to have confidential transactions, right? So that no one can really monitor how you're moving your money around or moving your tokens around.
Oh yeah. And some Monero dev explained to me how during Riga how that worked, but that was after like a 10-hour day with lots of interviews and lots of amazing conversations. So my mind was already sufficiently blown. And let's say that I didn't fully understand yet how confidential transactions work and the math behind it, but at least I'm one step closer.
Right.
But it's complicated.
Mm-hmm.
That's the long and short of it. Okay, interesting. And so do you think that, or for what will these asset issuance be used? Will there really be ICOs on Liquid?
It depends. Like it's just technology, so people can do what they want to do with it. It could be used for an ICO. It could be used for an STO. You could use it to issue airline points, whatever you like.
Cool. And we talked yesterday about that on the Consensus Rhine network, the Finnish Cryptocurrency Association, that we have all around us billions and billions of scarce goods, physical scarce goods that are, if Alice has this pendant, gives it to Bob, it's no longer hers. That's a scarce good, and it's physical. There are thousands, billions, uncountable amounts of that. What is being used as a money? One out of all of these, gold, well, kind of silver, but rather gold. And probably the same will apply in the cyberspace, right? In information space. Now that we have the beautiful ability of issuing scarce digital assets, with Bitcoin being the first one that works in a decentralized and leaderless fashion, we might now see billions of digital scarce goods, but only one of them being used as a money. So do you believe in this kind of Andreas vision of several tokens and everyone having their own?
Well, I think a lot of people will try to have their own because there are gains and benefits to creating your own money, and that's why people do it, even with fiat. But I think ultimately there's going to be only a few left standing at the end, just because I don't think people can deal with a massive number of monies in the world. And you also want to have the soundest money. I think it's a concept that Sidechain or somebody was talking about, but you don't want to spend the best money. You would keep the best money, whatever holds the most value over time, and you'll spend the crappier money. So you'll spend dollars first.
Exactly. And Gresham's law applies until that point where you no longer have any of the crap money, but only hold sound money. And at that point, you can fully only use Bitcoin, which is a beautiful place to be. Maybe one question to kind of finish this up is that when creating a peg-in, you require 102 Bitcoin confirmations on chain. So 102 Bitcoin blocks being added to the blockchain after your peg-in transaction was added to the blockchain.
Yeah.
For the peg-out transaction, it is only 2 blocks on the Federation sidechain. And that only takes 2 minutes. So, of course, we have the confirmations on chain to prevent reorganizations of the blockchain. And why is the reorganization problem minimized on a sidechain?
Just because it is federated. So I think you can only reorg 1 block. I think it's just by design. Whereas with mining, it's really up in the air.
Okay, and when you say by design, how enforceable is it? And so, because proof of work, right? You have to do the work. That's the entire point.
Right.
Is this that you can only reorg 1 block? Is this more of a soft like meat space consensus, or is it hard math?
I can't explain the math, but it's to do with the signing. Because it is federated signing, then you can only move ahead if everyone signs, right? So there could be some edge case where there might be 1 block reorg, but I can't explain the comp sci behind that.
Okay, and so even if 100% of the federation would collude, could they reorg the chain?
Not really, because you cannot. They can only either turn the box on or turn the box off. They can't really do any manipulation of the transactions or blocks.
Okay. And so when you phrase it like that, who's actually proposing the block? So who's creating the block candidate before it is being signed?
So it's the transactions would go out to all the members. And I think based on the design, one of the members would propose a block in every round. It would be a different one.
Yeah. Okay. Cool. Okay, Samson, we've already talked about a lot, and I know you're busy. You got lots of stuff to do. But maybe to finish out, is there anything else that you'd like to mention, and some points that you'd like to emphasize?
I think just keep an eye on what's happening with Liquid. We've got a lot of new stuff coming out. We have a Block Explorer on the way, and we have a Liquid wallet that's being built by the Green Address team. So some people might be wondering, how do I start to use it? It'll be as we roll out different parts of the ecosystem. For now, it's just we're just focused on building and getting exchanges to integrate, and that's going to be the bottleneck before everyone can access it.
Okay, yeah, and for the users, there will be wallet integration in the Green Address wallet on your phone, Android and iOS, which is really cool. Coming a bit after the main update in, I think, next week. So we're really looking forward to the new design and the new Green Developers Kit for Green Address.
Yeah.
Okay, Piers, we have been joined by the amazing Samson Ma from Blockstream. So that was quite a fascinating discussion, and we talked a lot about the Elements projects, which is a project or a fork of Bitcoin, and being able to issue both self-containing blockchains and, of course, the really interesting sidechains. And specifically, we talked about Liquid, the sidechain developed by the Blockstream team. And of course, read the white papers. They are actually quite accessible. And back in 2014, so this is no new stuff. This is kind of old and boring tech. The Strong Federation is rather new, so that's January 2017, but still approaching 2 years. Read them. They are accessible, and they will hopefully answer some of your questions. And I also do hope that some of your questions have been answered here on the World Crypto Network. Really, thank you for all the support in the chat and for hanging in there. Thank you for Bitcoin Jake again for the $2 donation, and all the community support in general. And Piers, you're awesome. You see that we've overshot our goal now. We've now received 0.324 Bitcoin for the amazing Purism Fund. So we are having enough funds now here to test the really, really, really cool Purism laptop, open source hardware, open source software, potentially the Librem 5 as well. But for now, let's stick with the Librem 15. And you will get a bunch of reviews and unboxings and all that good stuff on the World Crypto Network, hopefully soon. So let's see where that will take us. Again, Samson, thank you very much for joining us here today on Open Source Everything to discuss sidechains and all your amazing stuff that you're working on at Blockstream. And continue the good work, and see you on the next show.
Okay. Thanks, Max. Take care.